Welcome to the Leaders Academy podcast. Today's episode, ESG is now a balance sheet issue, what CFOs can no longer delegate. CFOs have been hearing ESG matters for a decade. What's actually different in 2026 that makes this a balance sheet issue rather than a branding exercise?
The regulatory floor shifted. The EU's Corporate Sustainability Reporting Directive is now fully enforced for large companies. The SEC's climate disclosure rules survived their legal challenges, and lenders are pricing ESG risk into credit facilities, not as a soft preference, but as a covenant condition. When your cost of debt moves because of your Scope 3 emissions profile, that's a balance sheet issue by definition.
Give me a concrete example of that debt pricing mechanism in action.
Siemens Energy refinanced a major revolving credit facility earlier this year with sustainability-linked terms. Toward, the margin steps up by 15 basis points if they miss their supply chain emissions targets. That's not symbolic. At their debt scale, missing those targets costs tens of millions annually. Volkswagen faced a similar structure and had to reforecast their interest expense when their EV transition timeline slipped.
So the CFO who delegates ESG to the Chief Sustainability Officer is effectively delegating Treasury risk management. How widespread is that misalignment?
Extremely widespread. BlackRock published data this year showing that roughly 60% of S&P 500 companies still have no ESG line item in their internal management accounts. The sustainability team produces a glossy report. The finance team produces the 10K. And the two documents don't reconcile. That gap is exactly where financial risk accumulates invisibly.
What does reconciling them actually look like operationally?
It means treating carbon as a cost center, not a footnote. Microsoft now runs an internal carbon tax, currently set at around $100 per metric ton, and charges it back to each business unit. That number flows into divisional P&L. Product managers are making capital allocation decisions based on it. That's the shift. ESG stops being a report and becomes a price signal inside your own organization.
What about companies that aren't Microsoft? Smaller enterprises without a dedicated sustainability infrastructure.
The entry point is simpler than most CFOs assume. Start with your top 20 suppliers and request verified emissions data. Tools like Watershed and Persephone can aggregate that into your existing ERP in weeks, not years. The EU's supply chain due diligence rules mean your European customers are going to demand this data anyway. You're either ready or you're a procurement liability.
Some executives argue ESG compliance costs are eroding margins in an already compressed environment. How do you counter that?
The cost of non-compliance is larger. Unilever estimated its stranded asset exposure from fossil fuel-dependent supply chains at over $4 billion if carbon pricing reaches projections by 2030. The compliance cost is a fraction of that. CFOs who frame this as expense versus investment are using the wrong accounting framework entirely.
One action a CFO should take before the end of Q3 2026?
Commission a climate scenario analysis using the TCFD framework and require it to feed directly into your next board risk register, not the sustainability appendix, the core risk register. That single structural change forces the conversation into the room where capital decisions are made.
To go further, Leaders Academy offers strategic training programs, diagnostic tools, and an executive self-assessment designed for CMOs, CDOs, CFOs, and leaders aiming for board-level performance. Explore everything at mba-training.com. Thank you for listening to the Leaders Academy podcast. See you tomorrow for another episode.